You probably drive past a half-empty strip mall like almost every single day, and you just assume it's a failing business.
Oh, yeah. People see those for lease signs sitting in the window year after year, and they actually feel a little bad for the owner.
Right. But what if I told you that a 40% vacancy rate isn't a sign of failure at all? Like, what if, in the right hands, that empty space is actually this carefully calculated multi-million-dollar gold mine?
It really is. It totally flips your perspective.
Exactly. So today, for you listening, if you love breaking down complex systems and connecting the dots on how wealth is actually generated in the real world, this deep dive is basically going to hand you the decoder ring. We are decoding a seemingly boring commercial real estate newsletter to reveal an entirely invisible layer of reality sitting right on top of your daily commute.
And it really is a hidden language, Once you understand the mechanics of how commercial space is valued and financed, you literally never look at a fast food drive-thru or your neighborhood urgent care clinic the same way again.
You stop seeing buildings and you start seeing financial instruments.
Precisely.
So we're looking at a single document today. It's a curated email newsletter from Eureka Business Group, or EBG. They're a retail investment advisory firm based in Dallas-Fort Worth. And this particular list of properties was compiled by their managing principal on June 27, 2026.
And honestly, at first glance, it reads like a standard kind of dry catalog of Texas commercial real estate.
Yeah, very dry.
You've got properties broken down by price brackets, just a ton of acronyms, square footage stats, zoning details, all that industry speak.
But I want to bypass that standard table of contents approach for a second, because the most important part of this newsletter actually isn't the real estate itself.
Right, it's the context.
Yeah, it's this small, almost administrative feature tucked right away in EBG's About section that explains why this email even exists in the first place. They heavily promote their expertise in, and I quote, 1031-driven replacement needs. And they even include a link to a custom 1031 exchange timeline calculator.
Which is such a crucial detail.
It is. Because that calculator implies this massive sense of urgency, like almost a panic. Why are buyers timing their real estate purchases down to the exact day?
Well, so that calculator is really the engine driving this entire sector of the economy. Section 1031 of the U.S. tax code is this provision that allows an investor to sell a property and defer all of their capital gains taxes on the profit.
Okay, all of them.
All of them. But provided they roll that money into a new replacement property.
Okay, let's ground that in some numbers for a second, because the math of compounding wealth gets, well, it gets pretty ruthless when taxes are involved.
Oh, absolutely.
So if I buy a commercial building for $2 million and then I sell it 5 years later for $5 million, I got $3 million in pure profit.
Right.
Normally, the IRS comes in and takes a massive chunk of that in capital gains tax.
Yeah.
I lose a huge percentage of my buying power before I can even look for my next investment.
Which brings your wealth creation to a grinding halt, basically.
Sure.
But if you execute a 1031 exchange, you take that entire $5 million, so the original principal plus the completely untaxed profit, and you plow it directly into a larger property.
Oh, wow. So you just kick the tax can down the road.
Indefinitely. You can do this over and over again, essentially trading up the monopoly board for decades, growing your wealth tax-free.
But there's a catch, right? And this is where that timeline calculator from the newsletter comes into play. The government doesn't just, let you hold on to that untaxed cash in your checking account while you casually browse Zillow for your next acquisition.
Far from it. No. The moment you close on the sale of your original property, this very strict, legally binding clock starts ticking.
A ticking clock.
Literally. You have exactly 45 days to formally identify a replacement property, and then 180 days to actually close the deal.
Wait, 45 days? That is nothing in commercial real estate.
It's extremely fast. And if you miss that 45-day window by a single minute, the exchange fails. The protective shield dissolves, and that massive tax bill comes due immediately.
That psychology is fascinating. It's a total high-stakes pressure cooker.
Yeah, it really is.
So EBG is sending out this highly curated list of properties every single week because their mailing list is full of buyers sitting on millions of dollars who are actively sweating under a 45-day deadline. They have to park that money in a physical asset quickly, or they face this financial ruin from the IRS.
And when a buyer is panicking to beat a deadline like that, the temptation to buy a terrible property just to save the tax advantage is incredibly high.
Right, you just buy whatever's available.
Exactly. And that's why EBG's philosophy statement in the newsletter is so specific. They write, "Not every opportunity is the right opportunity. work with an advisor who knows the difference.
So they are positioning themselves as the calm voice of reason.
Right, acting as capital markets advisors to ensure that this ticking clock doesn't force a disastrous financial decision.
Okay, so with that 1031 pressure cooker in mind, let's look at the actual assets these investors are rushing to buy. EBG breaks the list down into price tiers, starting with properties under $3 million.
The entry level, basically.
Yeah, and the poster child here is a 2,684 square foot single-tenant retail space in Pearland, Texas. Looking at the photo in the newsletter, it's just a standard Jack-in-the-Box fast food restaurant.
Yep, very typical.
But the bullet points highlight an absolute NNN lease extended through 2031 with 28-plus years of operating history at this specific signalized hard corner.
Okay, so this represents the ultimate defensive play for an investor coming out of a 1031 exchange.
Defensive how?
Well, if you just made a fortune and your primary goal is wealth preservation and passive income, you want an absolute NNN, which stands for triple net lease.
Okay, let's break down the physical reality of that. Because if I buy, say, an apartment building and the roof leaks or the HVAC system dies in the middle of a Texas summer, my phone rings at 2 a.m. and I have to pay to fix it.
Exactly, you're a landlord.
Yeah.
But with an absolute triple net lease, you sleep through the night.
Nice.
The tenant, so in this case, the corporate entity behind Jack in the Box, they agree to pay for all property taxes, all building insurance, and all maintenance.
Wait, all maintenance?
Yeah.
So if the parking lot needs repaving...
They pay for it. If property taxes spike, they cover the difference. The landlord simply opens their mailbox and collects a rent check. It is the closest thing to a completely hands-off physical asset in existence.
Wow. It feels like owning a municipal bond that you can drive past and order fries from.
That's a great way to put it.
Because the cash flow is highly predictable, the structural headaches belong to someone else entirely, and you have this captive marketing because it sits on a signalized hard corner. Like you're stopped at a red light, you look over, and the drive-thru is right there.
Right. Human behavior and traffic patterns are really the bedrock of land valuation.
Yeah, that makes sense.
EBG actually highlights this metric beautifully with another listing in this under $3 million tier. It's a 1.66-acre lot of raw commercial land in Fort Worth.
Just empty dirt.
Just empty dirt. But the leading selling point isn't the soil quality or anything, it's the traffic. They highlight 104,000 plus VPD, which is vehicles per day, nearby.
Over 100,000 cars driving past every single day.
Exactly. That metric alone dictates what that land is worth and why EBG suggests it for a quick service restaurant or a medical build-out.
But, and tell me if I'm wrong here, there has to be a critical trade-off with these ultra-safe, under $3 million properties.
There is. Since the risk is virtually zero, the financial yield is correspondingly low.
Right.
Furthermore, you face a massive hidden danger, which is inflation risk. If you sign a rigid 20-year lease with a fast food chain and inflation skyrockets, your fixed rent check loses its purchasing power year after year.
That makes perfect sense. There is a ceiling to the Jack in the Box.
A very hard ceiling.
It's a safe harbor for a 1031 exchange. But if you need aggressive growth to outpace inflation, you can't just set it and forget it. You have to actively force the value of the property up yourself.
Which requires a completely different mindset. And that moves us right into the $3 to $7 million tier. This is the domain of the value-add investor.
Okay, I want to look closely at a listing in this middle tier, a 7,039 square foot retail center in Fort Worth. It has the signalized hard corner. It has 29,000 vehicles per day. Crucially, EBG notes it is 100% leased.
Sounds perfect.
It does. But then right in the middle of the selling points, they highlight below market rents. Now, to a casual observer, an investment firm bragging that a property is undercharging its tenants sounds totally paradoxical.
Oh, it seems completely backwards until you understand the underlying math of commercial real estate valuation.
Okay, unpack that for us.
Well, commercial buildings are not valued like single-family homes. A residential house is valued based on comparable sales in the neighborhood, right? Like, what did the house next door sell for?
Right, the comps.
Exactly. But commercial property is valued almost entirely based on a mathematical formula involving its net operating income, or NOI, and something called a capitalization rate, or cap rate.
Okay, let's dive into the mechanics of that formula because I feel like this is where the actual wealth is minted.
It is. The cap rate is essentially the yield an investor expects to earn for taking on a specific level of risk in a specific market. The formula is surprisingly simple. You divide the net operating income by the cap rate to determine the property's fundamental value.
So let's run a concrete example to show the how of this value-add strategy. Let's say this fully leased Fort Worth property is generating $100,000 a year in net operating income.
Okay.
And let's say the local market demand a 5% cap rate for this type of retail strip.
Under those conditions, $100,000 divided by 0.05 gives you a property value of exactly $2 million.
Okay, $2 million. But EBG told us the previous owner was lazy, or maybe just nice, and kept the rents artificially low.
Right, below market.
So the new investor buys the building, waits for those current leases to expire, and adjusts the rents up to match the actual going rate in the neighborhood. Let's say that raises the net operating income by just $20,000 a year.
Okay, so now your NOI is $120,000. You divide that new income by the same 5% cap rate, and suddenly the fundamental value of the building is $2.4 million.
That is staggering. By simply managing the property better and raising the rent a few dollars a square foot, the investor hasn't just gained $20,000 in extra cash flow. They have instantly forced $400,000 of new equity into the value of the building itself.
That is the power of the cap rate multiplier. And it's exactly why below market rents is literally the most exciting phrase a value-add investor can read.
They aren't buying the building, they're buying the mathematical gap between what the building is currently earning and what it should be earning.
Precisely. It's all about the upside.
I love that concept.
Okay.
But let me push back on another listing in this tier that seems to violate the basic rules of investment stability.
Sure, let's hear it.
So EBG lists a 16,800 square foot industrial and flex space in Roanoke, Texas. In their Why We Like It section, their top reason is short-term leases. Now, if I am deploying $4 or $5 million from a 1031 exchange, I want the stability of a 10-year contract. Why is EBG spinning a lack of long-term commitment as a positive feature?
It comes down to control. Remember, if your entire strategy relies on forcing the value up by renovating units and raising rents, long-term leases are actually your worst enemy.
Because you can't touch the rent.
Right. They lock you into the previous owner's outdated math for years. Short-term leases, on the other hand, provide incredible agility.
Oh, I see. So you buy the Roanoke property, wait maybe 6 months for the current leases to end, and you have a blank slate.
Exactly. You can kick out underperforming tenants, restructure the asset, or, and EBG points this out, this is a massive owner-user opportunity.
What does that mean in practice?
Well, imagine you run a rapidly expanding logistics company. You need a warehouse with fully built-out air-conditioned offices and outside fenced storage. This property has all of that. You can't wait 5 years for an existing tenant to leave. The short-term leases mean you can acquire the building, let those leases expire, and move your own operations in almost immediately.
Ah, so the short-term lease isn't a liability at all. It's the operational runway needed to actually execute the strategy.
You got it.
Which brings us to the final tier of the newsletter. The heavy hitters in the 7 million plus category. And I feel like this is where the strategies of passive safety and aggressive value add really collide.
They absolutely do. This tier introduces the most critical component of large-scale commercial real estate, which is the anchor tenant.
Okay, let's look at the 16,959 square foot retail center in Flower Mound, Texas. It's brand new, 2024 construction, sitting on a signalized hard corner.
Beautiful property.
But EBG clearly notes it is about 40% vacant. For $7 million, buying a building that is nearly half empty sounds terrifying to me.
It does sound risky.
But the defining feature they highlight is a corporate guaranteed urgent care anchor tenant.
Yes. And we see a very similar structure with their massive Austin listing. It's a 25,335 square foot retail center that is 82.2% occupied, and it features a bank anchor tenant.
You know, I think the best way to visualize this dynamic is to imagine a massive commercial cargo ship.
Okay, I like where this is going.
So the corporate anchor tenant, the bank, or the urgent care clinic, is the anchor contract that pays for the ship's fuel, the crew's salaries, and all the maintenance. They sign these ironclad 15-year leases.
Right.
And because of their immense corporate backing, they guarantee that the ship is going to sail regardless of economic weather.
That is a perfect analogy, because that is exactly how the banks underwrite these massive loans. A commercial lender will not give you millions of dollars to buy a half-empty building based on hope.
No bank is going to do that.
Never. They provide the financing because that corporate anchor tenant mathematically guarantees the baseline mortgage payments.
Okay, so if the anchor tenant covers the overhead, what does that make the 40% vacancy in Flower Mound?
Well, keeping with your analogy, the vacancy is the extra deck space on the cargo ship. Since the voyage is already paid for by the anchor, the captain can lease out that empty deck space to smaller, local businesses.
Like a boutique fitness studio or a specialty sandwich shop.
Or a nail salon, exactly. And every single dollar generated from those smaller side stages is pure profit that aggressively drives up the net operating income.
Man, it is the ultimate value-add play disguised as a risk.
It really is.
You buy the safety of the anchor, and you leverage the bank's money to buy the opportunity of the vacancy. EBG even spells this out for the Austin property. They literally write 82.2% occupied, arrow pointing to value add.
The strategy is brilliant, but it does rely heavily on the resilience of that anchor tenant. Think about the specific anchors EBG highlights here: a bank and an urgent care clinic. Why those specific businesses?
Well, because they are highly resistant to e-commerce disruption. I mean, you can't get physical stitches over a Zoom call, so the urgent care clinic is basically Amazon-proof.
Absolutely Amazon-proof.
And banks invest millions of dollars into their physical footprints, building massive steel vaults and secure drive-thrusts. They have incredibly sticky local deposits, meaning they very rarely abandon a location once they build it.
Right. The physical infrastructure ties them to the real estate, providing the ultimate downside protection for the investor's 1031 exchange money.
But the risk remains, doesn't it? If that corporate headliner goes bankrupt or just decides not to renew their lease after 15 years.
Then you suddenly have a massive hole in the hull of your cargo ship, and the entire valuation of the center collapses. It's high stakes.
Wow. This has been an incredibly revealing journey through a single document. We started by uncovering the ticking clock of the 1031 exchange. That relentless pressure driving wealthy investors to constantly roll their capital into new assets to avoid devastating tax hits.
And we saw how they seek the passive safety of an absolute NNN lease, effectively buying a corporate bond that comes with a drive-through window, trading those high yields for a life totally free of maintenance headaches.
But then we explored the limits of that safety against inflation, which pushed us into the mechanics of the value-add strategy. We did the math on cap rates, proving that finding below-market rents and utilizing the flexibility of short-term leases allows an investor to force hundreds of thousands of dollars of equity into a property simply by optimizing its income.
And finally, we scaled up to the $7 million tier, where investors use the ironclad guarantees of corporate anchor tenants to satisfy bank underwriting.
Creating a secure foundation to gamble on leasing up massive vacancies for pure profit.
Exactly.
So, the next time you are out running errands, sitting at a red light on a signalized hard corner, just take a look at the commercial landscape around you.
It changes everything.
It does. When you see an urgent care clinic anchoring a brand new strip mall with a few empty storefronts next to it, you aren't just seeing local businesses trying to sell you flu shots and sandwiches. You are looking at the physical manifestation of cap rate math, triple net leases, and incredibly careful value-add investment strategies.
You are watching the gears of a massive financial engine turning right out in the open.
Which leaves us with a final, somewhat mind-bending thought to chew on. If the tax code actively penalizes investors for holding onto their profits and essentially forces them into this perpetual 1031 exchange cycle of constantly trading up, evaluating every property for its value-add potential to raise rents and flip it again, does a city ever actually finish being built? Or is the physical world around us just an endless life-size game of Monopoly board trading where the board itself is designed to never stop shifting? Keep your eyes open out there.